Investing in funds like ETFs and CEFs as part of your high yield investing approach can be really beneficial, especially to investors who want a more passive, hands-off approach, because by investing in funds instead of individual stocks, you don't have to listen to earnings calls, you don't have to look at investor decks, you don't need to analyze balance sheets and value businesses, etc. Instead, you simply just buy a diversified fund, let them set your portfolio, and you just put things on autopilot and let the power of compounding work for you over time and collect the dividends, reinvest them as you see fit, etc. That being said, not all funds are the same, right? Some are actually going to be pretty powerful long-term wealth compounders, whereas others are not so much. And in this video, I'm going to talk about two funds that I think are quite overrated by a lot of dividend investors, and I would personally steer clear of, especially right now, and then two funds that I think are underrated by dividend investors, or at least many of them, and I think that I would view them as worthwhile investments right now. But before I get into today's video, if you could please give this video a like and subscribe to my channel. It would really help me out a lot with getting this video distributed to a broad audience and help me grow my channel. Thank you very much. Okay, so the first fund that I think is overrated right now is a CEF, or a closed-end fund. Its ticker symbol is PDI. It's by PIMCO. It's got a high yield. In fact, its dividend yield is well over 13%. And so that lures in a lot of investors. It pays out monthly distributions, so a little bit over 1% per month right now at the current yield. So that's very attractive to a lot of investors because they want that high cash flow, and it invests in a lot of debt investments. So again, there's that contractual return that you're getting. So there's a lot to like about PDI. However, there are several reasons why I would not buy it right now. The first is that it trades at a whopping 13% premium to its underlying net asset value. And that in itself obviously is objectively quite high, but that's also quite high even relative to its own history. Its historical average over the past 52 weeks is just 9.5%, so it's quite a bit above that. And its 52-week high is a little over 14%. And so it's actually trading quite close to its 52-week high, especially relative to its 52-week average. So even on its own historical basis, PDI looks quite expensive right now. Another reason why I'm not a big fan of PDI is that it has over 37% leverage applied to the fund right now. That is a very, very high leverage ratio for a fund, because that means that if the market were to crash and the economy with it, and say a lot of its underlying loans were to go into default and lose a lot of their value, it may be forced into a margin call. And what this means is that its leverage ratio would get too high relative to the covenants that its lenders have set for it. And so therefore it would have to sell some of its underlying holdings in order to bring its leverage ratio back down into within its covenants. And this would lock in permanent losses on those loans at a time when the market is very bearish on them. And so that's a horrible time to sell for a value investor. It would also significantly reduce their income stream and therefore likely force them to cut their dividend quite steeply potentially. This risk is further aggravated by the fact that its underlying portfolio is invested overwhelmingly in junk or non-graded debt investments. In fact, less than 10% of its investments are investment grade. And so there's a high risk to a lot of its investments that if the economy were to go into a downturn and experience some distress, a lot of its loans would likely be stressed as well, potentially even go into default, or at the very least non-accrual and have to be restructured. So there's a lot of risk underlying this fund that the leverage only amplifies further to you, the investor. And we can see this in past history where the fund during market crashes, for example, in the 2020 COVID crash, the underlying NAV of the fund plummeted and stock price plummeted by even more. And so when you layer on the fact that it currently trades at a massive premium to its net asset value, with the fact that its net asset value itself is pretty shaky, especially during times of economic downturns, further compounded by the fact that there is heavy leverage. It's over 1/3 leverage as a fund. And the fact that its NAV, like I said, is very shaky because of the weak quality of the counterparties to its loans. It is a fund that could very possibly see a massive decline in its stock price if we were to go into any kind of economic distress scenario, and the dividend would likely be cut as well. So those are some reasons it's really risky. And the last reason I don't really like PDI in general, even aside from the current dynamics facing it, is that it has a 1.89% expense ratio, making it very, very expensive. You can get a lot of ETFs, high yield investment funds. You can invest in high yield bonds, et cetera, with ETFs for expense ratios of under 0.5% in the public market. So again, I think that the risk reward here is just not great. If I want a actively managed fund that's going to have some leverage applied to it, I'd rather invest in a BDC, because again, those are a lot. You can buy some quality BDCs I've discussed elsewhere that trade at a discount to their net asset value instead of a large premium to it. They generally do not have any covenants on their debt, and so they're much more conservatively financed. And again, they have really good workout teams. I'm not saying PDI doesn't either, but again, if you want exposure to this lower quality, high yield debt that's leveraged, I think a BDC vehicle right now that's trading at roughly in line with or at a discount to its net asset value is a better approach than PDI right now. The second high yield fund that I think is overrated right now is ticker symbol QYLD. Now it invests in the NASDAQ 100 and has a very high monthly dividend payout that it has to shareholders. In fact, I think it offers a little bit over 1% per month at the current level. And so it's very attractive to many investors because most high yield investors don't normally have exposure to mega cap technology stocks because those stocks just don't pay much in the way of dividends. And so if you want a high yield, you're going to be mostly focused on sectors like REITs, MLPs, utilities, BDCs, etc. And so QYLD kind of helps to meet that need by employing a covered call strategy on its underlying NASDAQ focused holdings. And so therefore it's able to generate monthly cash flow from those covered call premiums, and it sends that out to shareholders via distribution. So it's a nice concept, but I don't necessarily have a problem with that as part of a well-diversified portfolio. However, QYLD, I just do not see how that is an advantageous fund to be invested in. First of all, it has a pretty high expense ratio. Its expense ratio is 0.61%, which if you look at a competitor of theirs, the JEPQ ETF, which is another NASDAQ 100 focused ETF that has a very similar strategy, very similar portfolio. They both have about 50% exposure to technology in their portfolios. Both pay out monthly distributions due to a covered call strategy. But JEPQ only has a 0.35% expense ratio. So why spend that extra 0.26% to the manager for a strategy in QYLD that is, in terms of the portfolio breakdown and the style of covered call and payout monthly, that's effectively the same as JEPQ? It doesn't make any sense. And on top of that, JEPQ actually has a much better track record than QYLD does. Over the period that they both have been traded publicly, it's about middle of 2022. JEPQ has generated total returns of over 30%, whereas QYLD has only generated total returns of about 13%. So on top of the fund differential, there's even a larger gap in their underlying performance. So again, it just does not make any sense to me to invest in QYLD when you have a perfectly fine fund like JEPQ that can meet the same need for your portfolio. Okay, now I'm going to talk about two dividend-focused funds that I think are underrated. And by underrated, I don't necessarily mean that no one invests in them, because the first one I'm going to name to you is one you're probably quite familiar with. It's the Schwab US Dividend Equity ETF, ticker symbol SCHD. It's very popular. It's well covered on YouTube. It's well covered on Seeking Alpha and many other financial channels. Has a lot of assets under management. However, recently it's been getting a negative rap. I've noticed a lot of negative comments and articles on Seeking Alpha, even some negative articles and videos about it. And that's because it has underperformed in recent years, because it only has 10% exposure to the tech space. We've had the AI boom. It doesn't invest in mega cap tech stocks. And so SCHD has lagged the broader market, even though before then it was actually performing very closely in line with the S&P 500. So I get it. People, they want to chase the hot stocks. Nvidia, Microsoft, Apple, etc. have been soaring to the moon over the past couple of years. And so people have been thinking, SCHD is dead money. It's a waste of time. That dividend's okay, but it's nothing great when I could be chasing higher returns by investing in the NASDAQ or at least the S&P 500 or just even these individual tech stocks. I understand. But moving forward, past performance is not indicative of future results necessarily. And so SCHD has a tremendous long-term track record of delivering returns that are very competitive to the broader markets, largely due to its very low 0.06% expense ratio, its very well-diversified portfolio, and it still gives you 10% exposure to tech, but it has much higher exposure to stuff like consumer defensive stocks, industrials, financial services, healthcare. These are sectors that have not been as much in favor recently, but over the long term, they're very durable. They'll generally do well when the economy goes down relative to some of these high-flying, more speculative growth names. And so given that we're kind of evolving in our cycle here, we're moving, the Fed's moving towards rate cuts. We have an economy that's on the brink of potentially sliding into recession. We've got a lot of geopolitical, macroeconomic uncertainty. I think it's helpful to be more diversified, to be in some more defensive sectors. And so I think that will serve SCHD quite well moving forward. And the biggest reasons why I like SCHD is because it's hard to find a well-diversified fund that offers you such an attractive combination of a decent current yield, especially compared to the S&P 500, but also give you very, very strong dividend growth. In fact, SCHD gives you that 3.4, 3.5% dividend yield right now, which is over twice what the S&P 500 is going to offer you. In fact, it's almost 3 times what the S&P 500 will give you right now. Combined with a dividend growth history of over double digit, so it's like 11% annualized dividend growth rate over the past decade. That's much higher than the S&P 500's dividend growth rate over that period of time. So you're getting the best of both worlds. You're getting the higher current yield and you're getting the higher dividend growth rate from a well-diversified portfolio that's expected to probably do better, or at least as well as the S&P 500 during a period of economic weakness. And so I think that now is a good time as part of a well-diversified portfolio, relatively speaking, if you have capital in both SPY or QQQ, maybe move some of that capital in SCHD, or at least new money I would put in SCHD over those other places for the reasons I just mentioned. Okay, and the final fund I'm going to talk about today, and this one is one that's not covered a whole lot. It's PFFR. It's by InfraCap company. It's a REIT preferred ETF. It doesn't get a whole lot of limelight. I think their PFFA fund gets more because it has a higher yield. It's a little bit more diversified, but it also has leverage and it has a higher expense ratio. And so with that higher leverage comes greater risk, that higher expense ratio, a greater hurdle for beating returns. So PFFA is not necessarily a bad fund, but it's totally different. I think PFFR is very prudent right now. Again, because we're going to a period of economic uncertainty, it's better to be a little bit more defensive with less leverage. I like the lower expense ratio. In fact, it's 0.45% expense ratio is even lower than the index preferred ETF PFF by one, which has a 0.46% expense ratio. So PFFR is one of the lowest cost preferred funds that you can buy today. And again, it's focused on REITs. So it gives you a 7.5%-ish dividend yield from REITs paid out monthly, but these are all preferreds. And if you have studied the REIT space, it is very rare that they go into bankruptcy. There have been a few cases. They're almost all mall REITs that, they're Class B, their business models got disrupted by Amazon and COVID. So a black swan on top of a major technological disruption. So a black swan on top of a major technological disruption. They were already very leveraged. They did not have very strong balance sheets. And so that sent them down the tubes. But generally speaking, REITs, though their returns may be mixed through cycles due to changing interest rates and some properties become more valuable or less valuable, preferreds have a lot of coverage from in the balance sheet. They're junior only to the debt. And so there's that safety inherent in there, both to the dividend as well as the net asset value of them. And again, as long as the business does not go bankrupt, that preferred is either going to be paying you dividends or at least accumulating future ones so that when it gets back on its feet, it can pay them out again. So again, it's not risk-free, but it's definitely a low-risk fund, especially how broadly diversified it is, and you get that 7.5% dividend yield. I wouldn't buy PFFR if you're looking for total returns, but if you want a very safe, reliable dividend from real estate, that's 7.5%. It's pretty high, especially when we're headed to an era of dropping interest rates, the Fed's cutting rates. I think PFFR is a good place to be right now as a defensive pick, especially if you're more of a defensive income-focused investor versus just trying to maximize your total returns. So there you have it. You have two funds that I would steer clear of in the high-yield space today, and two funds that I think are much more worthwhile to buy. And I even threw in a bonus one in JEPQ as an alternative to QYLD. I think that's another one. I wouldn't necessarily say it's underrated because, again, I think tech stocks are pretty rich value right now, which is what JEPQ is concentrated in. But if you're going to have tech exposure with a covered call strategy to boost your yield, JEPQ would be my pick. So hopefully this video was useful to you. Again, if you liked it, if you could please give it a like. Please subscribe to my channel to help me grow and reach more people with this unique content on dividend investing. And of course, let me know in the comments below as well what you thought. That also helps with video distribution. And I genuinely would love to hear what you think of these, both the ones to avoid, the ones that I think are worth buying, as well as any other funds that you'd like to share with our audience. Thank you very much. See you next time.